Now, in this account I just showed you, when I either close out or roll over the buy right trade, I will take the proceeds from that trade and do another buy right trade. So that allows you to compound your results. And if you're receiving a 30% cash dividend and you roll that over several times, that really accumulates quickly. So it allows you to compound your trading results. Now, in this account, by rolling over the trades, I collected $152,000 in option premium. And again, this had a $311,000 starting balance. So the $152,000 I collected in cash income resulted in an average cash payment of 49% for that portfolio. By rolling over, I was able to collect a lot of option premium that amounted to 49% of my starting balance when I started initiating these positions. So the 49% gave me a lot of downside protection no matter what happened in the market. So this portfolio, I had it diversified across different industry groups. All of the trades were profitable at the time I took this snapshot. So in this example, I had a high percentage of winning trades because of the option income. Now, I normally will take profits on a buy right or an option spread trade if the trade reaches 90% of its profit potential. And I'll show you how I calculate that here coming up. I was able to exit trades several months before option expiration, then I can take those proceeds and roll them over into other trades. And sometimes I would do it on the same stock. Sometimes I would do it on a different stock if it was a better opportunity. So I normally will take profits if I get 90% of the profit potential. And I put those in as good till canceled orders so that I don't have to watch the market. I just put it in and it sits there, and then if the stock gets up to my profit target, I automatically exit. So that's how I was able to compound the results and get a 49% cash payment for that portfolio.
Close out both the stock and the option?
Yes. The question is, do you close out the stock and the option? And yes, I put it in as a good till cancel buy right exit order. Now, at E-Trade, I can just I go in and I can use their trading software, just their regular trading platform, and I can put that order in as a good till canceled, and it'll automatically sell the stock, buy back the option at my debit price. Or actually, when you're exiting, it would be a credit price. So that's done all automatically. Now here's a example of a bearish option income trade example. I purchased a bearish ETF for the emerging markets, the symbol's EEV. I bought 300 shares of the bearish ETF at 96.80, and I sold to open 3 of the 120 strike calls at 20 points. So three of the 120 strike calls at 20 points, so I received $6,000 in cash for the sale of that option. And this was August and September of 2008. And for most of these markets, the emerging market, Brazil, the major trend system went short around August, September of 2008. So it was actually a little bit before the big collapse. So I was already positioned when the big collapse came on the short side. Now here's a buy right analysis of this trade where I bought the stock at 96.80 and sold the 120 strike call at 20 points. I had some downside protection on this. If the stock went down 10%, I'd have a 13% return. If the stock stayed flat, or the ETF stayed flat, I'd have a 26% return. And if the ETF went up 25%, I'd have a 56% return. That's the analysis for that particular trade. So you can see you had protection there. In this case, it's upside protection in case that ETF rallied. That's an example of a short trade. Now, I took a snapshot of one of my trades. This is a buy right trade. I bought 1,000 shares of Mosaic stock, which is a fertilizer stock. And, or no, I bought 1,500 shares at an average price of 42. Then I sold 15 of the 40 strike calls at 790. Now, after I initiated this buy right, the price of Mosaic stock went down, but I was still able to profit because even though the stock was down $1,633, I had a profit on the option of $5,187. So net result was, instead of having a loss on the stock, I had a $3,500 profit on the buy right trade because of the short option. So that's just an example of how the downside protection works, and you can make money even if the stock goes down.
Is that because you sold it in the money? I see the stock is $42. You sold it 40 strike price.
Well, yeah, the question is, did this happen because it was in the money? And it doesn't matter whether it's in the money or out of the money. The option is still going to protect you, but you have more protection if it's in the money.